the trust collapse that shook the century. It started with a whisper, one doubtful remark exchanged between traders, then repeated in crowded streets and quiet parlors. A single trust company, once considered unshakable, faced rumors that cracked its polished exterior. And in an age when confidence was currency, that whisper carried the power to shake the entire financial world. To understand why this moment mattered so profoundly, we need to return to an America bursting with ambition. The industrial age was in full stride. Cities towered higher each year. Fortunes rose and fell with breathtaking speed. Trust companies, once modest custodians of states, had transformed into aggressive financial engines, offering high returns, bold investments, and opportunities that traditional banks considered too risky. For millions, they represented a new era of prosperity. Yet beneath their gleaming lobbies and polished reputations lay a fragile truth. Their success depended on unwavering public faith, and their rapid expansion outpaced the safeguards needed to support it. They took on deposits without federal protection. They invested heavily in volatile markets. And though their ledgers glowed with profit, their structures were thinner, more exposed, more vulnerable than the public realized. The earliest cracks appeared quietly, a delay in repayment here, a sudden shift in a major investment there. Nothing dramatic, just subtle tremors beneath the surface. But in a world fueled by rumor and speculation, tremors had a way of becoming earthquakes. A single article in a local paper questioned the stability of one major trust. Competitors dismissed it. Executives issued calm statements. Yet the tone of reassurance revealed something deeper. They were worried too, and the public sensed it. Depositors who once walked through marble doors with pride now felt a twinge of unease. Investors paused before signing their names. Brokers exchanged terse glances on trading floors. These were small reactions, almost invisible on their own, but together, they signaled a shift in the emotional temperature of the financial world. One that would soon ignite a panic none of the institutions were prepared to face. These opening moments laid the groundwork for a crisis that would test the limits of trust itself, revealing how fragile a financial empire becomes when its foundation rests not on gold or regulation, but on belief. The unease surrounding the trust companies deepened as scattered doubts hardened into fear. Depositors who once admired the opulence of marble halls now hurried through them with urgency, withdrawing funds just to be safe. Lines formed before sunrise, stretching around city blocks. A single rumor had become a movement, and that movement carried a force no institution could fully withstand. Inside the trust companies, executives scrambled to maintain control. Ledgers were reviewed with trembling precision. Gold reserves were tallied and retallied. Letters were dispatched to allies begging for temporary support. Yet every reassurance they issued seemed to heighten suspicion rather than ease it. When a company insists everything is fine, people tend to wonder why it needed to say anything at all. Meanwhile, the panic rippled into the broader economy. Businesses that had relied on trust-backed loans suddenly found their credit lines frozen. Construction projects halted mid-frame as workers waited for wages that might not arrive. Merchants dismissed shipments they could no longer finance, leaving goods stranded in warehouses. Even companies unconnected to the trust felt the strain as the flow of money tightened across entire cities. Newspapers amplified the crisis. Headlines speculated about insolvency. Editorials questioned whether trust companies had grown too aggressive, too reckless, too detached from the traditional safeguards that had long protected the banking world. Every published word added weight to the growing sense that the problem was not confined to a single institution. It was systemic, spreading alive. Political leaders attempted to calm the situation, but their messages revealed uncertainty. Some urged the public to remain patient. Others blamed speculation, foreign capital, or lax oversight. But none could explain how an industry that had risen so quickly, with so much public enthusiasm, now threatened to drag the entire economy into chaos. Their indecision fed the fear, rather than dispelling it. Behind closed doors, the most powerful financiers in the country convened to assess the damage. Trust companies had become too interconnected to fail quietly. Their collapse would not remain local. It would sweep across banking networks, stock markets, and trade routes. Every delay in intervention deepened the risk. Yet even among these titans, disagreement simmered over whether the trust deserved rescue or reprimand. On the streets, emotion overpowered analysis. Depositors pleaded for access to their savings, many clutching account books as if holding them tightly might preserve their worth. Police were called to maintain order at overcrowded branches. And woven to the commotion ran a single unspoken truth. Trust, once broken, could not be restored by accounting alone. The crisis was no longer a quiet tremor. It had become a full-scale confrontation between public fear and institutional fragility, a clash that would soon force the nation's most powerful figures to decide how far they were willing to go to stop the collapse. The confrontation reached a new intensity as the panic spread from one trust company to another, moving with a speed that defied every effort to contain it. Institutions that had once stood as symbols of modern finance now faced crowds demanding answers they could not give. Each attempt at reassurance, each carefully worded announcement, each polished statement, fell flat against the raw fear gripping the public. The crisis had outgrown facts. It had become emotional, unpredictable, and dangerously contagious. Inside boardrooms, the atmosphere shifted from tension to desperation. Executives who had built empires on confidence and bold investment strategies now confronted the harsh limits of their position. Their assets were tied up in long-term projects. Their liquid reserves were thinning by the hour. And the one tool they needed most, public trust, had slipped beyond their reach. Some urged immediate disclosure of their books. Others insisted that transparency would invite ruin. Every option carried risk. Every delay carried more. The pressure soon hit Wall Street with full force. Stock prices, already wavering, tumbled as investors sold off anything connected to trust companies. Brokers struggled to keep pace with orders that flooded the exchange. The trading floor, normally a theater of calculated momentum, dissolved into chaos as panic replaced strategy. A single company's trouble had become a signal that none were safe. The system trembled under a weight it had never been designed to bear. Beyond the financial districts, the ripple effects deepened. Factories shut down temporarily as operating cash vanished. Workers were sent home with uncertain promises of return. Small banks, many holding deposits or securities tied to the trusts, faced their own withdrawal lines. Even wealthy individuals, confident in their influence, found themselves unable to secure immediate liquidity. The machinery of commerce slowed with alarming speed, revealing how interconnected the nation's prosperity had become. Newspapers, sensing the scale of the disaster, published increasingly urgent stories. Some blamed reckless speculation. Others pointed to weak regulation or the unchecked rise of financial institutions operating outside traditional banking structures. But the public no longer cared about causes. They cared about survival, about retrieving their savings, protecting their livelihoods, and understanding how stability had dissolved so suddenly. In political halls, the debate sharpened into conflict. One side demanded immediate intervention to prevent total collapse. The other insisted that rescuing the trust would reward irresponsibility and entrench dangerous precedents. As lawmakers argued, the crisis intensified, threatening to overwhelm not only the financial system, but the government's ability to respond. Yet the most consequential discussions took place far from the public eye. In the private library of one of America's most powerful financiers, leading bankers gathered to confront the crisis directly. The stakes were clear. If they failed to act, the entire system could collapse within days. But even among these titans, disagreements flared over strategy, responsibility, and cost. Whether they could reach consensus, and whether that consensus would be enough, remained painfully uncertain. The nation now stood at the brink. Trust had crumbled. Institutions were faltering. And the rescue that might avert catastrophe depended on a handful of individuals whose influence stretched across the entire financial landscape. The climax of the crisis was approaching, carrying with it the question that would define the century. Could panic be stopped once it had taken full control of the nation's imagination? The climax arrived in a single night that would be recounted for generations. An urgent gathering where the nation's most powerful financiers faced the reality that the entire system stood seconds from collapse. Surrounded by ledgers, telegrams, and anxious advisors, they confronted a truth no one wanted to say aloud. If they failed to act now, trust companies would fall in waves, dragging banks, businesses, and millions of Americans into a crisis unlike anything the nation had ever witnessed. The discussions were sharp, tense, and relentless. Every proposal carried staggering risk. Inject capital? Guarantee deposits? Force weaker institutions to merge with stronger ones? None of these options were clean. None were fair. But doing nothing meant collapse. As midnight deepened, a reluctant consensus formed. Private capital would intervene to stabilize the system. It was not charity. It was survival, forged in the understanding that the fall of one pillar threatened the entire structure. The rescue effort moved swiftly. Couriers delivered funds. Telephone lines crackled with orders. Trust companies teetering on the edge received emergency support. And by dawn, the immediate freefall had slowed. Markets were still shaken, but the spiral was no longer accelerating. Ordinary citizens woke to headlines describing a coordinated intervention that had, for the moment, held the financial system together. But the relief was complicated. The panic had exposed brutal vulnerabilities, the dangers of unchecked expansion, the fragility of institutions built on thin reserves, and the catastrophic speed at which confidence could evaporate. The rescue saved the system, but it did not erase the questions now echoing through the country. How had so much power accumulated in institutions lacking the safeguards of traditional banks? Why had trust companies been allowed to grow without oversight? And what would prevent this crisis from happening again? In the months that followed, those questions drove reform movements across state and federal levels. Lawmakers debated new standards, capital requirements, and oversight bodies. Some argued for comprehensive structural change. Others resisted, wary of placing too much authority in centralized hands. Yet the memory of withdrawal lines, shuttered windows, and the near collapse of the national economy pushed the conversation forward. Reform was no longer a theoretical idea. It was an unavoidable necessity. Looking back, the trust collapse stands as one of the most revealing financial crises in American history. It showed that systems built on confidence must be anchored by more than optimism. It revealed that rapid growth without guardrails creates vulnerabilities too deep to ignore. And it demonstrated that in moments of profound uncertainty, the stability of an entire nation can depend on decisions made in one room, on one night, by individuals who never asked to shoulder that burden. The shock of that era still resonates today, shaping how we understand risk, regulation, and the delicate balance between innovation and oversight. Because in the end, the crisis was not just about money. It was about the fragile architecture of trust that holds every financial system together.